Stocks tend to do very well after bear markets. Hi, I'm Chad Olivier, certified financial planner, CEO of Olivier Group. Stocks do very well after bear markets. This chart given to us by Carson Investment Research and Ned Davis Research, going all the way back to 1987 and taking us to for the last bear market, 2020. We're currently in a bear market right now. A bear market is stocks going down more than 20%, and that's considered a bear market. And we're in that right now. And so I just wanted to show you what tends to happen at the end of the bear market and the next year and the year afterwards. And we can go back and look at 1987. This section here is the actual negative return during the bear market. And so you can see in 87 down 33%. The year afterwards up 22, up 52. Then we takes us into 2000, 2001. We do tend to see a little bit of see some down years from the 2000, 2001. That is the September 11th attacks. But afterwards, big returns right after this. If you can see in 2002, 23% up, 36% up, and then going all the way down. 2020, we were down almost 34% during COVID. 2020, next year up 74%. Still don't have the numbers for the following year, but on average, the market the next year has produced about 30% from the lows and about 37% the following year from the lows. And so what tends to happen is when you come out of the bear market, money goes very quickly into the stock market and tends to make up make up those losses very fast on the upside. And so a question we get often from clients, or maybe more along the lines of a comment, is, this is going to take years for it to come back. It doesn't. When money comes back into the market, especially when you see big, very good companies selling for a deep discount, money tends to come in very quickly, and the returns end up giving us extraordinary returns for a number of years. And so, look, we're in the bear market right now. When we come into October tends to be what's known as the bear market killer, which a lot of times the bear market makes its low in October, but then it has the big bounce up. And that's what we've seen in history in the past, that the low hits in October and then that big bounce up. And once that bounce hits, then you'll see money aggressively coming into those into the actual stock market. Keep in mind, the stock market is just businesses. That's what you're investing in. And businesses go through periods of time where sometimes there's some uncertainty that they'll be able to keep growing at a certain percentage. And then what a good business does is it tends to sometimes pull back a little bit, not do so much spending, maybe not do so much hiring, lay off some people, get its books ready for there's going to be somewhat of a bad time. And then when things start getting better, and then they'll start the process of growing and growing again. So, and then the market is always looking 6 to 9 months ahead. Many times, clients ask us, what's going to happen if there's a recession? Many times when there's a recession, the anticipation of the recession is where the stock market gets beat up. When you're actually in a recession, the market's always looking 6 to 9 months ahead. That's when you'll see that the increase is happening, when we're actually in a recession. And then you'll start to get the news media to make statements like Wall Street's not paying attention to Main Street. Main Street's hurting and Wall Street's not paying attention. Well, Wall Street is paying attention. What happens is they beat up the Wall Street, they beat up the stocks, 6 to 9 months before. And by the time we actually get to the recession, then you see you start to see some momentum start to build, and things do much better. What's also interesting is that we are in a midterm election year. So midterm election years, another chart here provided by Carson Research. Midterm election years tend to have negative years those first 3 quarters of the year, and then the last quarter and the next year tends to have very positive returns. And you can see this going all the way back from 2018, our last midterm election, going all the way back to 1946. And you can see the next year after the midterm elections, the S&P 500 with some very good positive returns. And keep in mind that during all these years, we were not in a bear market. So that last chart I showed you, that's coming out of bear markets and how the increases usually happen. Many of these were not in an actual bear market. I'll give you an example. 2018, which was a very interesting year with the midterm elections. The market was actually down 19% and closed the end of the year just down about 4.5%, and then had a nice increase the following year at 12%. The average increase after the midterm election, 14% on average. So we feel very confident in our positions right now. And again, the October is always known as the bear market killer. We shall see, but we do feel very confident in our positions. And if you have any questions, give the office a call, shoot us an email. Thank you.